I have a document in front of me today that, honestly, if you saw it sitting on a desk, you'd probably use it as a coaster.
Okay.
It's the ACCA Performance Management Examiner's Report for the September and December 2025 exam sitting. And I know, I can hear the collective sigh.
It does sound like the definition of dry, doesn't it?
It really does. But I'm asking you to stick with us on this one.
Please do.
Because as I was reading this, I realized this isn't really about passing a test. This document is basically a catalog of the most common logic traps that smart people fall into when they try to analyze a business.
That is exactly the right way to frame it. An examiner's report is essentially a forensic analysis of human error. It shows where thousands of aspiring financial managers tripped up, where they missed the point, and crucially, how the perfect analyst thinks.
And we're going to get into some really counterintuitive ideas today.
Oh, yeah. Like why working backwards is a superpower in finance, why big data is useless without a very specific human element, and this idea of fixing a product's cost before you've even built a single unit.
Fixing the cost before you build it. I love that. We're definitely going to get to that when we talk about target costing. But let's start with what the report calls Section A.
Right. The mental gymnastics.
This is where they had a company called Baringo Co. that apparently stumped a lot of people.
Baringo Co.
Yeah.
Yes. This was a classic test of whether you can reverse engineer a financial picture.
So usually in finance and just in life, really, you're given the inputs. You know, here's the revenue, here's the cost.
Calculate the profit.
Right, it flows forward. But this question just flipped the script completely, didn't it?
It did. The question asked for the carrying value of the equity. In plain English, that's just asking. What is the shareholder's slice of the pie actually worth?
Okay, simple enough question.
But here's the catch. They didn't give you the equity number. They gave you the answers to other calculations and asked you to work backward to find the starting point.
It's like a logic puzzle. You have the clues, but you have to unwind them to get back to the source. So lay out the clues for us. What do people have to work with?
They had 4 specific numbers. First, operating profit, which was $6 million.
Okay.
Second, the interest cover ratio, which was 12 times. Third, the interest rate on debt, which was 4%. And finally, the gearing ratio, which was 45%.
Okay, let's pause right there. Before we do the math, we need to define terms. Because interest cover and gearing sound like, I don't know, mechanic jargon.
They do a bit,
Yeah.
but they're vital health metrics for any business.
So what do they actually mean?
Well, think of interest cover as a safety buffer. It asks, how many times over could you pay your interest bill with your current profit?
Ah, okay.
If your cover is 1, you are living paycheck to paycheck. If it's 12, like Ringo Co., you're very safe. You have 12 times the profit you need to service your debt.
That makes sense. It's a measure of breathing room. And gearing.
Gearing is essentially leverage. It compares how much debt you have to how much equity you have. A 45% gearing ratio means for every dollar of equity ownership, the company is carrying 45 cents of debt. It measures risk.
Got it. So the candidates had these ratios, the safety buffer and the leverage, but they needed to find the actual dollar value of the equity. Where do you even start pulling that thread?
You start with the relationship between profit and interest. Operating profit is $6 million.
Right.
Interest cover is 12 times. Since interest cover is just profit divided by interest payable, you can do a simple rearrangement.
So if profit divided by interest is 12, then profit divided by 12 must be the interest.
Exactly. You take the $6 million, divide by 12, and boom, the interest payable is $500,000. Now you have a foothold. You have a hard number.
Okay, so we know they pay $500,000 in interest, and we have another clue. The interest rate is 4%.
Right. And this is the next step in the reverse engineering. If that $500,000 represents 4% of the total debt, you can find the total debt.
You just divide the 500,000 by 0.04.
And that tells you the total debt is $12.5 million.
Okay, I'm seeing the path now. We've gone from profit to interest payment to total debt.
And the final step leads us to the answer. You have the total debt, $12.5 million. You have the gearing ratio, 45%, which defines the relationship between debt and equity.
And in this problem, debt is 45% of equity.
So you take that $12.5 million in debt, divide it by the 0.45 ratio.
And you arrive at the equity, $27.8 million.
Which was the correct answer.
What I love about this is that it forces you to understand the relationships between the numbers. You can't just memorize a formula for equity.
No, because there isn't one for this situation.
You have to understand how leverage, interest, and profit all pull on each other.
That's the takeaway. The examiner's report noted that candidates struggled here because they are used to calculating forward. But in the real world, say you're analyzing a competitor, you rarely get their clean internal spreadsheets.
Right.
You get bits and pieces, a ratio from a press release, a profit figure from a news article. You have to be able to work backward to see the reality.
Speaking of reality versus the textbook, let's talk about the learning curve. There was another case, Deluti Co., a guitar manufacturer.
Right. They're making a new model called the Keras. And this highlighted a very common human error.
What's that?
The tendency to overcomplicate things to prove how smart we are.
Oh, I feel seen. We all do that. We want to show off the fancy math we learned in university.
We do. So here's the data. The first batch of guitars took 1,500 hours to make.
Yeah.
The second batch took 1,350 hours. The question asked for the learning rate. Basically, as they get more practiced, how much faster are they getting?
And I assume people tried to bust out complex algebraic formulas.
Yeah, they did. There is a complex formula involving logarithms to calculate learning curves when output changes by random amounts. It's useful, but it's heavy lifting.
But not needed here.
Not at all. Because here, the output just doubled. They went from one batch to two batches.
So you don't need the complex math.
No. There's a specific concept called the doubling rule. It simply states that every time cumulative output doubles, the cumulative average time per unit falls by a fixed percentage. You just need a simple table.
Okay, walk us through the simple version.
Batch 1 took 1,500 hours. Batch 2 took 1,350. Total time for two batches is 2,850 hours.
Right.
The learning rate applies to the cumulative average time.
Right.
So what's the average time per batch when you've done two?
2,850 divided by 2 is 1,425 hours.
Right. So your first batch averaged 1,500. Your first two batches averaged 1,425. To find the rate, you just compare them.
Divide 1,425 by 1,500.
And that gives you 0.95, a 95% learning rate.
Simple arithmetic. Simple arithmetic. But because candidates were primed for a hard exam, they ignored the simple path. The lesson is to look at the data structure before you choose your tool. If the output doubles 1 to 2, 2 to 4, 4 to 8, keep the algebra in your pocket.
That leads perfectly into the next topic from the report, which is actually about the philosophy of data itself. They brought up the big data pyramid. And I feel like big data is such a buzzword, but the report breaks it down into 4 distinct layers.
It does. And understanding the difference between these layers is critical for anyone in management. The layers are data, information, knowledge, and wisdom.
Okay, let's unpack this because I think people use these terms interchangeably and they shouldn't. Data is the bottom layer.
Yes. Data is raw, unstructured. It's just numbers in a database. It's user 456 clicked button X at 12:00. It's not useful yet.
It's just stuff.
It's just stuff. Then comes information.
Information is when you analyze that data for trends or patterns. For example, noticing that a specific group of customers, say people under 30, is clicking that button more than anyone else. That's a link. That's information. Okay, moving up. Knowledge.
Knowledge is knowing how to apply those links. You know the details of exactly who those customers are and why they like the features. You might know people under 30 click this because it reminds them of a social media interface.
And then, at the very top, the peak of the pyramid, wisdom. This sounds very philosophical for an accounting exam.
It is, but it's where the money is. The report explicitly says, wisdom is where value is added using insights. It's the decision-making payoff.
So it's not enough to know the pattern?
No. Or even why it's happening. Wisdom is having the insight to say, therefore, we should launch this new product line in this specific market next quarter because we know it will convert. The report mentioned that candidates often confuse these steps. They think finding the pattern is the end goal.
Right. But if you don't reach wisdom, if you don't make the informed decision, you haven't actually added value. Data without wisdom is just noise. It's a cost center, not an asset.
Let's apply some of that wisdom to the next section, target costing. This is where we get into the story of Printer Universe Co.
Yeah, great name.
I love this name. They are launching a new printer called the Zone. And this introduces a concept called feed-forward control. Can you explain that? Because usually we talk about feedback fixing things after they break.
Right. Feedback is reactive.
Mhm.
You made a mistake. You see the red ink on the monthly report, and now you fix it. Feed forward is proactive. It's looking into the future, seeing a problem that hasn't happened yet, and fixing it now.
And target costing is the ultimate form of that.
It is.
So walk us through the math for Printer Universe. How do they set this target?
They start with the market. They have a rigid selling price for the zone printer, $500. The market dictates that. They can't change it. They also have a strictly defined target profit. In this case, they wanted a return on investment that worked out to $120 per unit,
Okay. Sell for $500, keep $120 as profit.
which means the cost must be $380. That is your target cost. You don't ask the engineers, how much will this cost to build? You tell them, you must build this for $380.
It's working backwards again.
It is. But here's the kicker. If the estimated cost is currently, say, $400, you have a cost gap of $20. You cannot start production until that gap is closed.
And this is where the exam gets really interesting because it tests business judgment. Printer Universe also had a cartridge, the Z1.
Right.
And they had a cost gap there, too. Current cost was $88, but the target was $82.50, a gap of $5.50. And the examiner asked, how do you close the gap?
And this is where we separate the good managers from the bad ones. There were a few options on the table. One was reduce the amount of ink in the cartridge.
That sounds tempting. Instant savings. Just put less in the box.
It is, but the report flagged this as a very bad idea. Because Printer Universe is known for durability. If you cut the ink, the cartridge runs out faster, you damage the brand's perceived quality.
You solve the math problem, but you kill the business.
Exactly. Short-term gain, long-term ruin.
Okay, so what about raising the price? Just cover the gap that way.
Also a bad idea. The price is set by the market. If you raise it, you lose sales volume. You might make your margin, but you'll sell so few units that your total profit tanks.
So what were the correct answers? What should they have done?
Two main strategies. First, negotiate. Go to your suppliers, specifically the casing supplier in this case, and demand a bulk purchase discount.
Smart. You bring the cost down without touching the product quality.
Exactly. And the second,
What's the second?
accept a lower profit margin. Sometimes to enter a market or support a main product like the printer, you have to accept that the cartridge won't hit its margin target right away. It's better to make a little less profit than to ruin the product.
That's a really nuanced take. It's not just cut costs at all costs.
Exactly. But then the report threw a curveball. Printer Universe wanted to apply this same target costing logic to their after-sales service department. And the examiner basically said, good luck with that.
Yeah, why is it so hard to apply these manufacturing concepts to services? The report listed 3 specific reasons.
It did. The 3 enemies of standardization. The first is heterogeneity.
Heterogeneity, so meaning everything is different.
Precisely. A printer is a printer. They are all identical. But a service interaction. Every customer is different. One might need a quick password reset. Another might have a complex hardware failure. You can't standard cost that.
That makes sense. And the second one was simultaneity.
Simultaneity means production and consumption happen at the same time. In a factory, you design the product, then you build it, then you sell it.
Right.
In a service, the customer is part of the production process. You can't pre-design the interaction to the penny because you don't know what the customer will say.
And the last one was perishability.
You can't put a service on a shelf. If you have a technician ready to work for an hour and nobody calls, that hour is gone forever. You can't store it in inventory. This makes planning efficient capacity and therefore target costing incredibly difficult.
It really highlights why the service economy is so much harder to measure than the manufacturing economy.
It requires a completely different management toolkit.
Let's move to the final section, the art of analysis. This covers section C of the report, where we meet Kaleen Co. and Kling Co.
Right.
Let's start with Kaleen. They sell washing machines.
Kaleen Co. is a lesson in product mix. They sell household machines and a big industrial jumbo model. The metric here was the weighted average contribution to sales ratio.
That's a mouthful.
It is. Basically, it's the average profit margin across
Right.
all their products. Now, here's the trap. The jumbo model had the lowest margin of all their products.
Okay, so it's the least efficient product they make.
Right. The examiner asked, what happens if you increase the sales volume of the jumbo model?
Well, usually you think more sales is better.
In total cash? Maybe. But the question asked about the weighted average ratio. If you sell more of your worst performing product.
Oh, your overall average margin goes down.
Exactly.
So you could be celebrating record sales of the jumbo while your CFO is panicking because the company-wide efficiency is actually dropping?
Precisely. The report warns that candidates often miss this. They discuss general impacts like profits will go up instead of the specific impact on the ratio. The mix of what you sell matters as much as the volume.
And the report also threw in a tech tip here, didn't it?
It did. Use the spreadsheet software. The exam is on a computer. Don't do these calculations on a scrap of paper. If you use the spreadsheet cells, you avoid rounding errors, and that can save you marks.
Good tip. Now, finally, Clenco. This is probably my favorite part of the report because it deals with the balanced scorecard during an economic downturn.
This is where we see the difference between a student and a manager. Clenco is the market leader in energy-efficient machines. But the economy is bad. Revenue dropped by 9.1%.
Oh, Shaw, almost 10% down.
Now, a weak analysis, what the examiner called the copy-paste trap, just looks at the numbers and says, revenue dropped 9.1%, so they failed their growth objective.
Okay.
Or they look at defect rates and say, defects fell from 0.69% to 0.64%.
Why is that bad? It's true.
It's true, but it adds zero value. You're just reading the table back to the examiner. They can read. The expert approach, the one that gets the marks, looks at context.
Okay, give me the context.
Revenue dropped 9.1%, but the overall market for washing machines declined by 11.9%.
So everyone was crashing, but Clen crashed less.
Exactly.
Yeah.
Clen actually beat the market. They likely increased their market share, even though their revenue went down. If you just look at the internal target, they failed. If you look at the external reality, they won. That is true performance management.
And regarding the defects?
Same thing. Don't just say they went down. Connect it to the strategy. Clen's values are quality and innovation. A drop in defects proves that despite the downturn, they didn't cut corners. They stuck to the strategy.
That's the insight.
That's the insight.
It's so easy to get tunnel vision on the internal numbers and just forget the world outside.
It is. And that's really the theme of this whole report, whether it's Baringo Co. and reverse engineering the equity or Clenco and the market context. The numbers are just the starting point.
So we've gone from the wisdom at the top of the big data pyramid to the feed-forward control of target costing, and finally to the contextual analysis of Clenco.
It's a journey from data to insight.
So here's a final thought for you to chew on. We talked about how hard it is to apply target costing to services because they are perishable and heterogeneous.
Yeah.
But look around. The economy is becoming overwhelmingly service-based. We buy subscriptions, experiences, consulting, software as a service.
It's true. The manufacturing era is shrinking relative to services.
So, does this mean traditional cost accounting, the stuff in this exam, is becoming obsolete? Or do we need to invent an entirely new pyramid for measuring value in a world where you can't touch the product and you can't store it on a shelf?
That is the multi-billion-dollar question, isn't it?
Something to think about next time you're looking at a spreadsheet. And for the listeners, take a page out of the Printer Universe playbook. Look for the gap in your own projects before you start building. It's a lot cheaper to fix it now than later.
Wise words.
Thanks for diving in with us. We'll catch you on the next one.